Most people believe markets move because of news. A headline appears, prices react, and the story feels complete. But that explanation is usually backwards. Markets don't fear bad news. They fear what most participants haven't noticed yet. Large price moves rarely begin at the moment a headline hits your screen. They begin earlier, in places most investors don't watch. Changes in positioning, shifts in liquidity, and pressure building across related markets. By the time price reacts, the underlying conditions have often been in place for days or weeks. That's why two people can see the same chart and reach opposite conclusions. One sees chaos. The other sees a system responding to incentives, risk constraints, and capital flows, doing exactly what they are designed to do. When prices move suddenly, the important question is not what scared the market. It's what changed beneath the surface that made the market vulnerable. This difference matters. If you focus only on headlines, every sharp move feels random and emotional. If you focus on structure, how markets are funded, how leverage behaves, how currencies and rates interact, you start to see patterns that are quieter, but far more informative. In this analysis, we'll step away from reactions and narratives. We'll start by clearly separating facts from interpretation, and then work forward, calmly, methodically, to understand what actually matters after a move like this. On January 29th, 2026, gold and silver experienced a rapid price reversal after a strong advance earlier in the month. Gold, which had been trading near recent highs around the mid-5,000s per ounce, declined sharply within a short time window, falling by several $100s intraday. Silver, which had significantly outperformed gold during the preceding rally, also reversed quickly, dropping by more than 10% from its intraday high. The defining characteristic of this move was speed, not just magnitude. The majority of the decline occurred within a narrow time frame, rather than through a slow, multi-day adjustment. This distinguishes the move from a typical pullback and places it closer to what markets describe as a rapid repricing. From a factual standpoint, several things are important to note. The decline followed a steep upward trend in both metals during prior weeks. The move occurred during active global trading hours, not in an illiquid overnight session. Gold and silver moved lower at the same time, rather than diverging. The move coincided with broader activity across macro-sensitive markets, including currencies and rates. Compared to the previous week, price volatility increased meaningfully. Compared to the prior month, the direction changed abruptly, but prices remained well above levels seen earlier in the year. No single official announcement or confirmed physical supply disruption occurred at the exact moment prices turned. There was no exchange outage, no halt in trading, and no change in the underlying specifications of gold or silver markets. In short, what happened was not a gradual reassessment of long-term fundamentals. It was a fast adjustment in market pricing after an extended advance, occurring in a context where multiple macro-linked assets were also in motion. At this stage, these are the observable facts. A sharp, synchronized decline in gold and silver prices, notable for its speed, following a strong rally, and occurring alongside broader macro market movement. A sharp move like this matters not because of the immediate loss or gain on a screen, but because it reveals how the market is structured at that moment. Markets do not reprice in isolation. They reprice through chains of cause and effect. The first link in that chain is usually positioning. When an asset has risen quickly, participation tends to increase. More traders enter, some with leverage, some through derivatives, some through systematic strategies that respond to momentum. This doesn't mean the trend is wrong, but it does mean the market becomes more sensitive to sudden changes in conditions. The second link is risk management mechanics. In leveraged markets, price declines can force participants to reduce exposure regardless of their long-term view. Margin requirements, collateral thresholds, and risk limits are mechanical. They trigger actions automatically. When enough participants are subject to the same constraints, selling can accelerate without requiring any new information. The third link is cross-market interaction. Gold and silver are not standalone assets. They are priced in US dollars, traded globally, and influenced by expectations around interest rates, currency strength, and liquidity. When conditions shift in one of those related markets, the effect can transmit quickly into metals pricing. This is where first-order and second-order effects diverge. First-order effect: price falls because selling increases. Second-order effect: price falls faster because selling itself creates more selling through risk constraints and hedging adjustments. Who feels this first depends on exposure type. Short-term traders and leveraged participants are impacted immediately because their risk is path-dependent. Long-term holders experience a mark-to-market change, but are not structurally forced to act unless their strategy depends on short-term price stability. The broader implication is this: moves like this often say less about long-term value and more about how crowded, leveraged, or interconnected the market had become. Understanding that distinction matters. If every sharp decline is interpreted as a verdict on fundamentals, decision-making becomes reactive. If it's understood as a function of structure and incentives, the same event can be analyzed with far less emotion and far more clarity. This section isn't about assigning blame or predicting the next move. It's about recognizing that markets are systems. When pressure builds in multiple parts of that system at once, repricing can be fast, even if the underlying asset itself hasn't changed. When markets move sharply, the natural instinct is to search for a past event that explains what comes next. That instinct is understandable, but it needs discipline. History is most useful not as a prediction tool, but as a way to reduce emotional bias. Gold and silver have experienced rapid drawdowns many times during broader uptrends. These episodes often occurred before a clearer trend reemerged, not after it ended. One commonly referenced example is early 2020. During the initial phase of global market stress, gold declined alongside risk assets. That decline was not caused by a sudden loss of belief in gold as a store of value, but by liquidity pressure and the need to raise cash across portfolios. Only later, after funding conditions stabilized, did gold resume its upward move. Silver's history shows an even more exaggerated version of this pattern. Because silver participates in both monetary and industrial narratives, it has repeatedly shown larger percentage swings than gold in both directions. Periods of strong performance have often been interrupted by sharp, unsettling pullbacks before any longer-term outcome became clear. What is important is what happened before outcomes were known. Volatility increased. Correlations across assets temporarily converged. Short-term participants reduced exposure. Long-term narratives were temporarily overwhelmed by positioning and liquidity dynamics. However, it's equally important to acknowledge what is different each time. Market structure evolves. The mix of participants changes. Derivatives, markets, ETFs, algorithmic strategies, and global capital flows are not the same today as they were 5 or 10 years ago. That means outcomes cannot be copied forward mechanically. History helps answer one question reliably. Is this type of move unprecedented? In this case, the answer is no. History does not answer this question with certainty. What will happen next? That distinction matters. Using history correctly means recognizing that sharp declines during volatile periods are a known feature of markets, not proof by themselves of either collapse or immediate recovery. They are moments of uncertainty, where probabilities shift and narratives compete. The value of context is not comfort, it's perspective. At this point, professional analysis shifts away from narratives and toward conditional outcomes. The goal is not to predict a single path, but to define what must be true for different paths to unfold. Below are 3 structured scenarios. None of them are forecasts. Each depends on specific conditions. Bull case, strength resumes. If financial conditions ease, then gold and silver could regain upward momentum. Conditions that would support this outcome include stabilization or decline in the US dollar, reducing currency headwinds for dollar-priced assets, cooling of interest rate expectations, particularly in real yields, which lowers the opportunity cost of holding non-yielding assets. Evidence that recent selling was largely position-driven rather than a broad reassessment of long-term value. Normalization of volatility, allowing risk-taking to return gradually. Under this scenario, the recent decline would be interpreted as a temporary reset following an extended advance, rather than a change in direction. Importantly, strength would not require immediate new highs, only the ability to hold key price zones and attract incremental demand over time. Base case, consolidation and repricing. If macro conditions remain mixed, then the most likely outcome is a period of consolidation. This scenario assumes the dollar and yields fluctuate within ranges rather than trending decisively. Market participants remain cautious after the recent volatility. Both buyers and sellers wait for clearer signals before committing capital. In this environment, prices may move sideways or in wide ranges, producing frustration for those expecting quick resolution. This is often when volume declines, short-term traders reduce activity and attention shifts elsewhere. From a structural perspective, consolidation serves a purpose. It allows leverage to unwind, volatility to compress, and expectations to recalibrate. While less dramatic than a rally or a sell-off, this outcome is common after sharp moves. Bear case, trend deterioration. If the macro backdrop continues to tighten, then downside pressure could persist. This scenario would likely require sustained strength in the US dollar, higher or rising real yields, continued reduction in liquidity or risk appetite across markets, evidence that long-term holders, not just short-term traders, are reducing exposure. In this case, the recent decline would be less about temporary mechanics and more about a shift in the broader environment that previously supported higher prices. A decisive bear outcome is not defined by a single down day, but by failure to stabilize after volatility spikes. Markets that cannot recover footing after sharp moves often signal deeper structural change. The key takeaway from scenario analysis is not which outcome feels most appealing. It's understanding that markets move through probability-weighted paths, not certainties. As conditions change, the probability assigned to each scenario should change as well. That flexibility, rather than conviction, is what defines disciplined risk management. After a sharp repricing, the most useful discipline is to focus on inputs, not opinions. Markets tend to move in response to a relatively small set of variables, even when commentary becomes noisy. Here are the indicators that matter most in this context. 1. US dollar index, DXY. Gold and silver are priced in US dollars, which means changes in dollar strength can influence their valuation globally. I'm not looking for daily fluctuations, but for trend behavior, whether the dollar is making higher highs, stabilizing, or rolling over. Sustained dollar strength tends to act as a headwind, while stabilization can relieve pressure. 2. Treasury yields and real yields. Non-yielding assets are sensitive to changes in interest rates, particularly real yields. Rising real yields can weigh on metals by increasing the relative attractiveness of yield-bearing instruments. What matters most is not a single data point, but the direction and persistence of yield movements. 3. Inflation data and policy expectations reports such as CPI and PCE matter because they influence expectations around central bank policy. Markets reprice assets based on what policy might do next, not what it has already done. Shifts in expectations can have an outsized impact even if the data itself is incremental. 4. Liquidity and market depth. I pay close attention to how price moves occur. Thin liquidity, wide bid-ask spreads, or sharp moves on modest volume can indicate fragility. Stable markets tend to absorb trades smoothly. Unstable ones do not. 5. Positioning and open interest changes in open interest can help distinguish between liquidation and fresh conviction. Rapid declines in open interest often suggest forced exits rather than deliberate long-term selling. These indicators don't offer certainty. What they offer is context. They help answer whether the market is digesting a shock, transitioning to a new regime, or simply pausing before the next phase. Periods like this test discipline more than insight. Large moves can create the illusion that something fundamental has suddenly changed, when in reality the market may be adjusting to shifts in positioning, liquidity, and expectations. The most important response is not speed, but clarity. Understanding what is confirmed, what is conditional, and what remains unknown helps prevent reactive decisions driven by short-term emotion. Markets reward preparation more consistently than prediction. That means sizing risk appropriately, respecting volatility, and accepting that uncertainty is not a flaw in the system. It is a feature of it. Nothing in this analysis is investment advice. It is simply a structured way of interpreting recent market behavior using observable data and established cause and effect relationships. As conditions evolve, conclusions should evolve with them. Patience, risk management, and long-term thinking remain the most reliable tools, especially when headlines are loud and price moves are fast. Hernapos